What is going on, investors? Hopefully you guys are doing well out there. And I tell you what, if you own Netflix shares for any length of time, including today, well, you're getting absolutely smoked in the after hours. This stock's down over 24%, down to about $262 per share. Talk about what this means from a technical perspective. This obviously comes on the heels of reporting Q1 earnings, which really missed expectations by quite a bit. But we'll also take a look at the shareholder letter. This is filled with lots of really doom and gloom language. We'll talk about that from an investor perspective as well. We'll jump into the numbers, take a look at the revenues, the profits, the cash flows, and we got to start talking about the valuation, which was about $150 billion before today. We're going to shave off, it looks like, another 20% heading into tomorrow. You're getting close to a $100 billion market cap on this company. And certainly if you have not been in Netflix for any length of time, or you like me, you've never bought this stock, this pullback really starts to get exciting. We'll talk about it from a technical perspective, talk about where areas, this thing is just falling off a table. We're not going to step in here and buy this one anytime soon, but it's certainly starting to pull into areas from a valuation perspective, from a technical perspective, that absolutely this stock is starting to look extraordinarily attractive. Now, on the year, stock's down 41%. We're going to go down another 20% tomorrow. That's a nice 60% drop on that one. I tell you what, if stocks like this that have positive cash flows, positive earnings, go down 60% in 4 or 5 months, if that doesn't get you excited, I'd click close on this video and go watch something a little more tame. Now, in terms of the revenue, that came in at $7.87 billion. We're referring to the Q1 numbers, which came out after the bell. That's just, and I say just, a 9.9% year-over-year revenue growth on this one. That is screeching to a halt. That missed expectations by about 70 million, shares obviously rapidly declining. They also gave guidance. We'll walk through that in a little bit more detail here when we get over to the numbers, but the guidance came in actually a little bit stronger on that revenue side, at least quarter over quarter. You're expected to come in between about $8 and $8.2 billion on that revenue side. The EPS got shredded a little bit, about $3 per share. The street was expecting close to $3.04. We'll talk about what that means for the company. Now, what's shredding the company is they lost these 200,000 subscribers over the past year, when this company was actually expected to gain 2.5 million subs. So instead of gaining 2.5 million subscribers, they actually lost 200,000, and that obviously has people heading for the hills. What also is having investors head for the hills for Netflix is when you open up the shareholder letter and the first sentence is incredibly bearish. It says, our revenue growth has slowed considerably as our results and forecasting below show. Streaming is winning over linear TV as we predicted, and Netflix titles are very popular globally. However, our relatively high household penetration, when including the large number of households sharing accounts combined with competition, is creating revenue growth headwinds. And we'll get into that more here in a second. But I do want to also touch on the number of households that are being shared. They say inside this shareholder letter that 220 million paying households is currently where Netflix stands, but Netflix estimates over 100 million additional households are essentially sharing or piggybacking off this 220 million. That includes over 30 million people just here in the United States and Canada, which has one of the highest prices, highest profit margins for this company. That certainly you can start doing kind of the back of the napkin math. If you can add $2 or $3, not necessarily to the whole 30 million people here in the United States and Canada, but maybe a couple bucks here and there every month on these piggybacking households, well, I tell you what, you can generate large amounts of money, and that's what Netflix is hoping for in the upcoming quarter. Now, what they also talked about is the fact that they finished Q1 with gross debt of $14.6 billion. I'll show that to you. They did some acquisitions, which kind of hurt their cash balance, although we'll show that to you on the balance sheet. But they talked about how they have this cash balance and they have this debt and they have a leverage ratio of about 1.3. That means they did not do any share repurchase activities during the quarter. Now, in hindsight, that's looking pretty darn good because the stock is down over 20% from where it was just at the beginning of trade today. But at some point, you'd like to see the confidence of Netflix step in here and buy shares, but they believe their cash and kind of their debt to leverage ratio is a little bit too high to get that going. Now, in terms of these numbers, we've got our shaded out quarter. That was the most recent quarter, but they also give you guidance. You see here on the revenue side, they came in at that $7.8 billion. That was up 9% year over year, up fractionally quarter over quarter. We're seeing we're going to get a little bit of an acceleration quarter over quarter. We're going to go from 7.8 up to this $8 billion. This is the upcoming Q2, but year over year growth is kind of in that 10% range, which is, not really super sexy. Okay. It's not like a Google. It's certainly not like a Facebook or even an Apple or a Microsoft at this point, looking far more like Amazon in terms of that growth rate. Operating income in the most recent quarter was actually stellar at $1.9 billion, close to $2 billion, in fact, but they're showing that that is likely going to slow down in subsequent quarters, down to about $1.73 billion. So despite the higher revenue forecast at about $8 billion in the upcoming quarter, they're expecting operating income to actually come in a little bit from 1.9 down to 1.7. And they even talked about in the shareholder level that their operating margins are going to be around 20%, whereas it was 25% in the most recent quarter. So expect subsequent quarters at closer to be 20%, in the upcoming quarter, expected to be about 21.5%. That's on the operating margin side. Now, what everybody is looking at are these global streaming paid memberships. You got to 221 million of those in the most recent quarter. That is 6.7% year over year growth, but the street was expecting far more than that. And it's a decline quarter over quarter. And we're going to do it again in the upcoming quarter. We're going to go from 221 down to 219. And I tell you what, if Netflix misses as much on their guidance for subscribers, well, it'll actually be lower than 219. That could have some investors very worried about this. We also have just 5% year over year growth on that, and global streaming net adds basically dropping 2 million in the upcoming quarter. That is a recipe for disaster. That is the biggest reason why this stock is absolutely falling off a cliff, because like we talked about, the operating income is actually pretty good. The revenue's not bad. It's not really high flying growth, but at some point the multiple of this stock is not priced in for a high flyer anymore, but it's really that guidance on that subscriber front, and certainly those operating margins come in. It was really the guidance, in my opinion, with Netflix that really took this stock down. Now, in terms of the United States and Canada streaming, we talked about how basically flat from a revenue perspective. We did see net paid additions go down. They had 75 million paid subscribers out here. That's down to 74. We talked about how in the shareholder letter, they believe that they have about 30 million people here in the United States and Canada kind of piggybacking off a family's membership. That's almost half of the membership. So if they're able to squeeze out a couple dollars on those people that are kind of freeloading off somebody else's membership, well, I tell you what, could be better days ahead for Netflix. They counteracted this decline in growth on the subscriber side by raising prices again. You're up to about $14.91 per average user. And again, they're looking to squeeze a little bit more out of that off the people that are piggybacking. You basically see this across the board. You see net paid ads in Europe, Middle East, and Africa going down. Latin America, you also saw net paids go down. You did see in Asia Pacific a slight tick up, but that is one of the lowest paid subs at $9.21 a user there. That's actually down quarter over quarter. So you're starting to see in some markets, they still have some small acceleration on that net paid additions, but it's being counteracted by the fact that maybe they're butting their heads up on how much they can charge there. That is also a problem for Netflix. Now, in terms of the hard numbers, we come over, we see those revenues of $7.8 billion. In December, you were at 7.7. Last year on a quarterly basis, you were at 7.1. You flow through your marketing costs, your technology and development, your G&A, and just your straight cost of those revenues. Again, very solid in a vacuum. This quarter on its own, very nice over at Netflix. Operating income coming in at that $1.9 billion. We talked about how the upcoming quarter, it's not going to be as good, but it'll still be about $1.7 billion. Start to annualize out $1.5 to $1.7 billion, and then come over here to about 100 and call it 10, $120 billion market cap on this one. And you can start to see, well, maybe maybe this valuation is start to make a lot more sense over at Netflix. Even after paying interest expense and getting a benefit from some of the cash that they have on, man, this company printed $1.6 billion worth of positive net income, relatively in line with a previous year period over at Netflix. We scroll down, we see the balance sheet. They talked about how they had $6 billion worth of cash. They have this $14 billion worth of long-term debt. So they feel like that ratio of debt to cash, they're going to be a little conservative and not buy back shares. Certainly from a technical perspective, might be supportive of them buying shares here in a moment. We'll talk about that here in just a second. But I did also want to talk about cash flows. When it came to Netflix, you had that $1.6 billion worth of positive net income just in a quarter after adding back in things like the content rights. So they buy these contents. They have to pay for the content up front. They monetize it over a long period of time. Obviously, everybody's paying essentially kind of a monthly membership for Netflix. So they monetize that over a long period of time. That is recognized here in cash flows off this $1.6 billion net income. You come down here to positive cash provided by the operating activities, $922 million. That was up considerably from last year and way over where you were at December. I tell you what, if you can keep printing about $900 million worth of positive cash flows in a quarter, you come over here again. I'll remind you, this valuation is going to be slashed by another likely 20% if these after-hour gains hold through into tomorrow, and they tend to do that with Netflix. In fact, I would expect maybe even an acceleration of this heading into tomorrow. The stock could be down nearly 30% heading into tomorrow. This valuation starts to make a lot more sense from a cash flow basis, from an operating margin perspective. Again, we're kind of ignoring some of the subscriber problems that they have and certainly a revenue growth perspective, but all those things could be solved at some point when it comes to Netflix. In the most recent quarter, they did pay down some debt, and that really negatively impacted their cash, whereas last year they had about $8.4 billion, and now we're closer to about $6 billion on that cash side when it comes to Netflix. Now, from a technical perspective, I've got us way zoomed out here with Netflix, and I'm going to highlight this blue line that I have down here, and I'm going to kind of increase its intensity, and it depends on where you draw these in. I did this with Lockheed Martin today, but longer-term trend line with Netflix, it could be that really since about 2017 on this stock, we've just been in a bubble with Netflix, and it's just going to revert all the way back down to the mean, which if it does here in the next day or two, and it's looking very much like it wants to, I'll highlight where the price is with Netflix today, because we've actually gapped down. We were trading up here earlier in the day, closer to about $350 per share on Netflix. It's gapped down in the after hours to this blue line here, which I'll change to maybe like a purple color just because we're feeling good here on a Tuesday, and we're closer to about $260 per share. And that actually takes us pretty close to a full retracement all the way back down to this trend line. You also have an area of support down here at about $240 per share. This 240 area with Netflix is where I have my eye, and I probably would not consider buying shares until we see that level touched. That was Netflix from a technical perspective, actually starting to look rather decent. From a fundamental perspective, this valuation is starting to make a lot more sense. Price to sales, price to cash flows, even price to earnings, starting to look pretty good. Now, what is looking really bad is the fact that their subscriber growth is going in the wrong directions, and their operating margins are starting to shrivel up as well. Competition is not going away with this company, but if they are able to solve some of their problems, and I think one of their bigger issues is the fact that they have all these piggyback accounts, nearly half of their paying members are sharing that with another households. If they can chop off a couple of bucks on each of those households, well, I tell you what, on a company that is making $1.9 billion in a quarter, if you add just a couple of $100 million, that would be really, really significant for this company. We'll see how they were able to navigate through that. But Netflix is vulnerable. But if you've been patient and have not been in this name before, well, this can be presenting as a fantastic buying opportunity. If you bought Netflix at a higher price, you need to learn how to set stop losses, especially when you make a violent move like this. The initial drop down from over $600 per share down to the 380s should have been your red alert call that you might want to start reducing your exposure to a stock like this, because quite frankly, it's going to take lots and lots of time to recover those gains at some point. But this stock should bottom out, and in the shorter term could create some really nice buying opportunities. That was Netflix for today. We'll see if this is a prelude to the rest of the tech stocks, and if it is, you might want to get your shopping list out. That was Netflix. Hopefully you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.